Let's get into the advisory now, putting a focus on investment trends for ultra high net worth families. Richard Felice from Belay Advisory joining me now. I mean, this is always a big topic to look at because we are seeing a lot of families increasingly shift more towards private markets. What are the trends you're seeing?
We are, yeah. We know that families more and more are investing like institutions, and what that often means is they're looking to complement the more liquid listed parts of their portfolio, like Australian shares or overseas shares, and incorporating access to private markets. And so, you know, the focus here is finding really good, compelling opportunities. We hear a lot about private credit. That's been a space that's had a lot of coverage recently. In this particular case, banks are pulling out of lending, and these ultra high net worth families are stepping in as the lender.
Wow.
As the lender. So there's opportunity there. If you can find the right borrowers, and the trick is always getting your money back and earning a healthy income return along the way. We're also seeing private equity, you know, acquiring stakes in full or in part in private businesses. And so traditionally that's been done through funds, and again the challenge is finding the top performing funds. But these families have the capacity to go direct, finding those private businesses themselves and having an element of influence over those businesses too.
How do you sort of hedge against some of the inflationary pressures as well when you're looking at areas to invest in?
Yeah, the type of asset and the asset class is often a way to do that. So with private markets, these families and investors will often look to things like infrastructure. So your traditional toll roads, airports, which offer good inflation protection. Generally, the toll is increases with inflation very often, and so that's a way of protecting.
You talk as well about talking to your clients about impact investing. Tell us what you're looking at here.
Yeah, so these families, again, they're looking for ways to give back, to have a social, positive impact. The challenge with this has always been finding good managers, but finding good returns that keep up with again, more traditional asset classes. So we're finding that families are using structures such as their family foundations and investing in things like affordable housing, which is often providing some income, but directly linking to a social positive impact.
So affordable housing, the likes of low-income housing, aged care, you mentioned.
Yep.
Real estate, Australians love real estate in general. What about the commercial side?
Yeah, commercial side, different parts are performing differently. We know office has been a real challenge since COVID and the vacancy rates with offices. We're seeing a lot more around retail shopping centres, so, you know, high foot traffic areas in, blue chip suburbs or locations in Sydney and Melbourne. Generally, the key is finding that motivated seller. Why do they need to sell, and will they accept a market price that is often at a discount to a valuation that's recent? And with that, you're buying in at a good price, but you're also getting a really attractive income yield as well. So retail shopping centres have been key there. Industrial's been a focus for a number of years, and depending on where you sit, where valuations are, you'll have a view on that. But again, office is just something that I think we're starting to see the tide turn in some areas, but still a really challenging space.
When we talk about the intergenerational wealth transfer, obviously with a lot of these ultra high net worth individuals you're talking about, they have foundations, there's going to be philanthropy and the like. But what are the sort of discussions about transfer, like generational transfer planning?
Yeah. It's really important to get the kids involved early. I think where we're trying is you've got mum and dad who often are first generation or made the money, and they want to get the kids involved. And so engaging with them early is really important. The foundation is a way to do that. It's something that they might feel passionate about in terms of who the donations are going to, and so they're happy to play a role in that foundation. And that's where it starts. They start to become familiar with the investment conversation or just elements of the family balance sheet, and then it starts to evolve into roles within the family. So beyond the foundation, perhaps sitting in family meetings or family boards, or just having more of an influence in what the family's doing investment-wise. And over time, what that's doing is helping with the transfer of that wealth because where it's going, they are more familiar and able to make investment decisions.
So obviously discussions early, but I imagine there must be some sort of paperwork needing to be put in place as well.
There are, yeah. There's always a reliance on external support. So your accountant has always been a trusted advisor, your wealth manager. These are people that will generally sit across generations as that trusted advisor. And they're really key in delivering the success of that wealth transfer over time as well.